Hey, kings and queens. I hope all is well with you guys. I want to come on and talk to you about these student loans. Listen, there's been a major change when calculating student loans. I have had clients come to me who are very, very prestigious, and they have $200,000 in student loans. And if you need to get an FHA loan, FHA has to use 1% of your balance. So that's a $2,000 a month payment. And that knocked a lot of people out of their debt to income ratio. So that has changed. We got a new mortgage letter from the Biden administration, from HUD, I should say. And this thing's changed. This came out on July the 17th, and it came into effect or in mid-August. So it's in effect right now. So student loans refers to liabilities incurred by educational purposes. So we know what student loans are. I sure know what student loans are. The mortgagee must include all student loans in the borrower's liabilities, regardless of the payment type or status of the payments. So you have to include them. They're on your credit. If they're on your credit, we have to include them in your debt to income ratio when you're applying for a mortgage. So it says, if the payment used for the monthly obligation is less than the month reported on the borrower's credit report, the mortgagee must obtain written documentation of the actual mortgage payment, the payment status, and the evidence of the outstanding balance in the terms from the creditor of the student loan. The mortgagee may exclude the payment from the borrower's monthly debt calculation where written documentation from the student loan program creditor or student loan servicer indicates that the loan balance has been forgiven, canceled, discharged, or otherwise paid in full. So, for outstanding student loans, regardless of payment status, the mortgagee must use the payment amount reported on the credit report or the actual documented payment when the payment amount is above zero, or 0.5% of the outstanding loan balance when the monthly payment reported on the borrower's credit report is zero. So that is major, guys. I know it sounds like blah, 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 like Charlie Brown's mother. But what it means is instead of us automatically, now FHA used to automatically 1%. Or whatever's reported on your credit report, whichever one is higher. So we usually would just go with 1%. But now they are allowing you to go with the payment reported on your credit or whatever's in your repayment letter. So if you're on an income-based repayment plan and this high is much lower than what's being reported on your credit, then you just get me that letter and we can use whatever is on that letter. And you can just call the student loan servicer and get that information from them. Or if you can't get that letter or it says zero on your credit report and you know you still owe student loans, then we can go down to 0.5%. So that $2,000 a month I mentioned earlier, it can go down to $1,000 a month. That may make a huge difference. $1,000 can make a huge difference in the amount that you're pre-approved for. So if you have questions or if you had some issues with student loans in the past, you can give me a call and we can go over it and see if I can get you that house. So give me a call. You have my cell, 301-326-7555. I am going to go into this in detail on a live coming up next week. So you guys can chime in on my live either here on YouTube, on Facebook, or LinkedIn. And then you can ask questions as I'm live, and I will post the details about that. It's going to be me and another colleague going on live discussing the effects of student loans on purchasing a home. So again, give me a call. You have my cell. Start your application, approvemesandra.com, or leave me a comment or DM me. Talk to you guys later. Bye.